Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. This week saw the 10-year US Treasury yield reach its highest level in almost a year, as investors begin to price in the extraordinary stimulus and spending plans of the new Biden administration. On top of the $900 billion spent in the last months of the Trump administration, we have a $1.5 trillion package that will probably be negotiated by Biden's team. Put these two together, $2.4 trillion on a $21 trillion US economy. That's another almost 10% of GDP. Extraordinary. What this shows us is the impact and determination of a new trio, Biden, Powell, and Yellen. As Yellen said in her recent testimony, right now with interest rates at historic lows, the smartest thing we can do is to act big. This is a challenge for investors because it puts upward pressure on US bond yields at just the point when inflation is beginning to rise. That's a challenge for equity market valuations. So in the charts ahead, we'll look at how far bond yields can go, what this means for financial markets, and what this means for our underlying policy. Confidence in the global economic recovery continues to grow, as you can see on slide 2. The Bank of America Fund Manager Survey, the largest in the world, shows those expecting a stronger economy at the highest level for almost 25 years. On the right-hand chart, you can see this echoed in metal prices. Nickel, platinum, copper, all up by 35 to 40% from a year ago. Oil almost back to its levels pre-crisis. Why is this happening? Because uncertainty is falling. The IMF Uncertainty Index shows this. It plots uncertainty against a range of global events: Brexit, the US presidential elections, the China-US trade spat. But it peaks at the coronavirus a few months ago when the uncertainty over the progression of COVID was at its height. That's fallen sharply. This has allowed manufacturing service to rise, the famous ISM, close to its 20-year high. All of this supported by the powerful new triumvirate that's driving US policy, Biden, Yellen, and Powell. So why does this matter? Surely economic recovery is a good thing. Well, it matters because it holds inflationary risks, and inflationary risks mean higher bond yields. You can see here on the left the upward march of the US bond yield, the 2-year bond yield remaining steady at 11 basis points. So that gap between the two, if you like, the yield curve, is beginning to steepen sharply. And that threatens equity valuations on the right. You can see the 12-month forward PE multiple for the US market at 21.8 is not quite its highs in the tech boom in '99, but it's well above the average level of the last 10 years of 16.1. So do we think those yields will go higher, and will that bring the end to the stock market party? Well, our answer is no for 4 simple reasons. First of all, simply the scale of the deficits today require negative real interest rates for some years to come. I've shown here in a chart from the Bank of England and the OBR the UK deficit by category, by size, for the last 200 years. You can see that for about 70 years, deficits were actually negative. People ran surpluses. 0 to 5% the norm for about 120 years. And those bars, yellow for traditional cycles, red for financial crisis, purple for pandemics, and blue for wars. We stand right out on the right at 19 to 20% deficit we're expecting this year. That is a level almost exclusively associated with war. And in war financing, you run negative interest rates for a long period of time if that's required. So expect central banks to be determined to keep those rates low. Secondly, of course, while we expect an uptick in inflation, you can see US headline inflation rising in 21, triggered by an uptick in oil prices and rising base effects. We don't think that will be a permanent effect. Why? Because the Federal Reserve have committed to allow the economy to run hot. When inflation has been running persistently below 2%, Chairman Powell said, appropriate monetary policy will likely to achieve inflation moderately above 2% for a time. So they'll let the economy run hot, inflation run above target. The third reason, certainly in the UK, is just the damaging parts of the economy, which is going to sit on any rebound in pricing power or wages. On the left-hand side, you can see the famous Bank of England fan chart, which shows the expected levels of inflation out to 2024, and we're going to hover around about 2%. Why in our view won't that be higher? Simply because of the damage to the service sector. I show here the decline in service consumption between Q4 2019 and Q3 2020 in the US, France, Germany, Italy, and look, the UK the lowest, a staggering minus 14%. We just had a very weak set of retail sales numbers today, and surveys out suggesting that 1 in 5 Oxford Street shops will be closed forever. Finally, there is a powerful need for policymakers to level up and help those in society who have been hit hardest by this pandemic. The IMF illustrate it very well on slide 8. They show the increase in unemployment on the left-hand side for those with a higher education and a lower education. You see the more highly educated in blue, both in emerging and developed markets, suffering much less unemployment. The same for age of workforce. Youth particularly hard hit, the younger people, along with minorities, along with women, along with other minority groups. So I think this will preclude central bankers moving too soon. So what does this mean for equity markets on slide 9? Well, you can see the extraordinary rally that we've seen from the third quarter of last year accelerating again last week, with emerging markets up 32% from January a year ago, world equities up 16%, gilt returns beginning to fade, up just 2%, and still the UK the laggard, but beginning to improve, down 14% or so. This, I think, can still continue. This rally has more legs, but volatility will likely be higher, as we see on the right-hand side as bond yields rise. And there'll be more pressure on some of the more highly valued stocks, particularly if their earnings disappoint. So we're still overweight equities, but cautiously so. Where possible, we have portfolio insurance, and we have a very style-neutral overall portfolio, and still we like our thematic trends and powerful dividend support. Thank you.